Today we're going to discuss continuation of our lessons on insurance companies. So last time we did already discuss insurance and its products and services, but now let's focus more on the insurance companies. When we say insurance companies, these are business who assume risk on behalf of their customers in exchange for a fee called premium. So we have already known that what insurance companies offer to us are protection. They assume the risk on our behalf or their client's behalf, and then in return, the customers pay for a fee, and we call that fee as premium. So why do people pay insurance? Because usually people are risk averse, meaning so they prefer to buy insurance and know with certainty what their wealth will be than to incur the risk and run the chance that their wealth may fall. So meaning, so in order to be assured of their properties, their assets, people are willing to pay for premium from insurance companies. So how does insurance companies profit? So they charge premiums that are sufficient to pay the expected claims to the company plus a profit. So meaning the premiums that their clients pay are enough to cover the claims that they will have in case the situation that they are being insured happen, plus it has a profit. So we can say that most people are risk averse. That's why they are willing to get an insurance from a company. Insurance allows the people, the insured, the beneficiary, to have a peace of mind that a single event can have only a limited financial impact on their lives. So, meaning to be complacent with their current assets or properties, they are more willing to pay because they are thinking that having an insurance will give them a peace of mind. So here is a graph of the number of persons employed in the US insurance industry from 1960 up to 2008. So we can see that from the 1960s, it has already risen up to more than 2 millions. A slight decline between 2000 up to 2005, but still rising in numbers. So these are the number of peoples in the United States who are employed under the insurance industry. Again, let's discuss the basic principles of insurance. First, there must be a relationship between the insured. When we say insured, they are the party covered by the insurance, and the beneficiary, the party who will receive the payment should a loss occur. So you cannot just take anyone as your beneficiary because you should prove that they will suffer potential harm if they will be declared as your beneficiary. So usually, the beneficiaries are spouses, children, parents, some siblings. So they have a relationship, a very close relationship. For example, you cannot just make your classmate, your neighborhood as your beneficiary because they are unlikely to suffer harm in case they get into an accident. So, but if your relatives, say your spouse or your parent or your children, of course, you will suffer a harm in case they were into an accident. Second principle is the insured must provide full and accurate information to the insurance company. So as much as possible, we will give all the pertinent details and information relevant to our application to the insurance company. For instance, when you're applying for a health insurance or life insurance, so you must declare all your health conditions to the best of your knowledge prior to your acceptance to the insurance company or to the plan itself. Otherwise, it might affect your plan if you will not give all the necessary details. Third, the insured is not to profit as a result of insurance coverage. So please take note that an insurance is not a profit. They are different. So if a third party compensates the insured for the loss, the insurance company's obligation is reduced by the amount of the compensation relevant to the number 3 principle. So if you have already claimed portion of your compensation from the insurance, so what they will do is they will deduct already the amount of money or funds you have already claimed. For instance, you got into an accident, you have an accident insurance, portion of damages have been already paid by the supposed perpetrator or the one who made the accident. So they will no longer pay you the full amount. They will deduct what you have already received. Because it will be a profit, can be a double compensation on your part. And we say that insurance is not a profit. Although insurances with investment, so those are different things. We are just saying here a pure insurance. 5, the insurance company must have a large number of insured so that the risk can be spread out among many different policies. If you are aware of the insurance industries, especially here in the Philippines, you might wonder why they are really into getting as many clients as possible. Because this is the nature of an insurance company. To cover the risk, to spread out the risk to many different policies, so they try to have a large number of insured. 6, the loss must be quantifiable. You cannot just insure matters or events or situations that are not or cannot be quantified. For instance, an oil field which is not yet explored or unexplored cannot be a subject of buying a policy Because how can you quantify that? That is still unexplored or not yet fully explored. Finally, the insurance company must be able to compute the probability of the loss occurring. So it's on the part of the insurance company. So they have what it takes to compute what are the chances, the possibility that a loss will occur in this certain scenario or event. So what is the purpose of having the 7 basic principles? So we want, or they want, to maintain the integrity of the insurance process. Without these 7 basic principles, people may be tempted to use insurance companies to gamble, or they will just speculate on some future events. On the worst part or worst case scenario, this behavior could undermine the ability of insurance companies to protect the persons who are really in need. Also, these principles provide a way to spread the risk among many policies. We have already mentioned here in the 5th principle, to establish a price for each policy that will provide an expectation of a profit in return. Because at the end of the day, insurance companies are profit-oriented. They don't just want to protect or help you, but they also want to earn profit. They want to be profitable as well. Some of the challenges in the insurance companies. First, we have the adverse selection. It occurs when the individuals most likely to benefit from a transaction are the ones who most actively seek out the transaction, are thus mostly likely to be selected. It is a scenario, adverse selection, where either the buyer or the seller has information about the product quality, while the other party, either the buyer or seller, does not have. So the other party has full knowledge, full information, while the other one does not have. This is most prevalent in the insurance market. For instance, who is more likely to apply for health insurance? Those people who are suffering from health problems, who are always sick. Who is more likely to buy insurance from floods, flash floods, or from the effects of storms? Those who live in places which are always being ravaged by storms or flash floods. So in those cases, the party more likely to suffer a loss is the party likely who will seek an insurance. Those who are weak, sickly, will have the best possibility, best chance to get an insurance company or to get an insurance plan. So what is the implication of adverse selection? The loss probability statistics, which are gathered for the population, may not accurately reflect the loss potential of the persons who actually want to buy policies. Meaning, not all your prospective clients are just willing to buy for the policies. Some of them, or majority of them, are suffering already from different cases. So the adverse selection problem raises the issue of which policies an insurance company should accept. So what does insurance companies do regarding adverse selection? Insurance companies must have found alternative solutions. For instance, if you are going to get for a health insurance, you have to show first to the company physical examinations result. They will check your previous medical records. And if they have already checked these records, they might exclude those what we call pre-existing conditions. So when we say pre-existing conditions, these are health conditions which are already existing to a specific client before he or she was accepted to a plan. So some health insurance would not reimburse or will not pay, will not settle obligations arising from pre-existing conditions. For instance, before you were accepted into a plan, you are already diabetic, suffering from hypertension, chronic diseases, heart diseases, etc. So this may not be insured because before the beginning, from the very beginning, you are already suffering from these conditions. So insurance firms often offer better rates to insure groups of people, groups rather than individual. Like those working in a particular company or business. So that's a group insurance. Because it can be, the adverse selection might be avoided in a group basis rather than an individual one. Second other issue in insurance is the moral hazard. It occurs when the insured fails to take proper precautions to avoid losses because losses are covered by insurance. So it is taking advantage of a situation, especially financially, because the risk will be shouldered by the other party. You will not make the necessary precautions. People will not make the necessary things that they must do because they are thinking that they are already insured. For instance, I will eat whatever food I want, even though it is not good for my health. Anyway, if I'm going to have my hospitalization, my insurance will pay for it. Or I will not lock the door of the car. Anyway, even though parts of it may be stolen or my car may be stolen or may be damaged, my insurance will pay for it. Or when there is a storm and you are often flooded and you have an accident or calamity insurance, you will not take care of your properties or asset because anyway, even though they will be ravaged by storms or flash floods, they are covered by insurance. So moral hazard, meaning we take advantage of the situation because in any way, they're already being covered by insurance. So one way that insurance companies can cover moral hazard or combat moral hazard is by requiring a deductible. What is a deductible? It is the amount of any loss that must be paid by the insured before the insurance company will pay anything. So this is what I have mentioned earlier. So if the one who made the damage to your car has already paid a portion of your claims, for instance, you will have a claim of 50,000 from damages and 10,000 from it has already been paid, the insurance company will no longer pay you the whole amount of 50,000. Rather, they will just pay you 40,000 because a portion of it has already been paid. So that is a deductible. In addition to deductibles, the other terms in the insurance contract may affect your plan. So there are other terms included in the contract, insurance contract, in order to mitigate, to lessen the possible risk. For instance, if you are insured against fire, so your contract must is that you must install a fire extinguisher or a sprinkler system on your business or on your house. So in that way, it will help them lessen the impact or possibility of having a fire accident in your house or in your business. So although deductibles and even the contract terms help with what we call moral hazard problems, it remains a very, very rampant problem in the insurance company or in the insurance industry. Third one, selling insurance. Another problem which is very common to insurance companies is that people often fail to seek as much insurance as they actually need. It is uncommon for people to get as many as insurance as possible. Why? Because they think of insurance as just an expense for them. They are not thinking of the supposed benefit from this. Like our human nature tends to cause us to ignore our mortality. For this reason, insurance, unlike many banking services, does not sell itself. It's hard to sell an insurance. The expense of marketing may account for up to 20% of the total cost of a policy. You know, insurance agents really earn a lot by selling insurance to their insureds. Because I personally know people into having an insurance as sidelines. They really earn a lot because almost 20%, around 20% of the insurance that we take is going to the agents. A good sales force can convince people to buy insurance coverage that they would never have pursued in their own way. You know, insurance agents are very, very good in marketing. They will try to convince you to get an insurance. But I'm not saying that getting an insurance from them is not good. Of course, the benefit is higher than the costs. But what we are saying is that insurance agents earn a lot from selling insurance plans to their insureds. And As I have researched, let's take consideration the situation here in the Philippines, because we say that unlike banking industries, uh, intermediaries or financial companies, so insurance companies are being left behind. As of 2021, first half of 2021, 41.4 million Filipinos have insurance or microinsurance. So if the population of the Philippines is 110.8 million at the end of 2021, so 37% of Filipinos have microinsurance. But if we compare it to people who have bank accounts, so in the year 2021, 51%, more than half of Filipinos have bank accounts. That is according to Multilateral Banks Global Findex 2021 database. So this just shows that people are more inclined into investment, into having a bank account rather than getting an insurance. But accordingly, the number of Filipinos getting an insurance, even if it's a microinsurance, is rising. So many Filipinos are inclined to getting an insurance. So insurance is unique because agents sell a product that commits the company to a risk. So there are different classification of insurance agents. Some agents may be independent, meaning they can work for a different or various insurance companies. So if their agreement or contract allows that, so it's okay. But some insurance agents have loyalty to the insurance company that they are into, just like the graph that I have presented earlier. So those are the numbers of employed in the insurance industry. So they can be independent or can be exclusive. So the compensation of insurance agents are by commission. To tell you honestly, the agents themselves are not usually not at all concerned with the level of risk that can possibly happen to you, because the agents themselves will not pay you. It will be the insurance company. They have already received their commission. But of course, they will try their best so that the beneficiary or even the insured will claim their compensation from the insurance company. So to keep control of the risk that agents are incurring on behalf of the company, what does the insurance companies do? They hire underwriters. Who are underwriters? They are people who review and sign off on each policy an agent writes, and who have the authority to turn down a policy if they deem the risk unacceptable. So the agents class are not the sole approver of the insurance plan. So to mitigate the risk of just having an insurance, they hire these so-called underwriters. But if the underwriters have further questions regarding the quality of the clients, they now are going to hire an independent inspector. And what does this independent inspector do? So they review the property being insured, like the house or any your cars, or request additional medical information like health status or medical records. So the final decision whether to accept the policy may depend on the inspector's report. The growth and organization of insurance companies. When we say mutual insurance companies, these are owned by the policyholders themselves. So the objective of mutual insurance firms is to provide insurance at the lowest possible cost to the insureds. So the policyholders are being paid dividends, which reflect the surplus of premiums over costs. So whatever will be the excess of all the collected premiums over the entire insurance cost, so it will be a dividend, a compensation for the policyholders who are also the insured. The good thing here is that because the policyholders share in reducing the cost of insurance, there may be some reduction in the moral hazard that we have already discussed. So a unique feature of mutual insurance dividend is that they are not taxed like the dividends they receive from the corporations. So in the United States, the Internal Revenue Service regards the dividends as just refunds of overcharges on insurance premiums. So in the United States, at least, it is not taxable. So that's a good thing for them. So this figure shows the number of life insurance companies in the United States from the 1950s up to 2008. So we can see its peak between 1985 out to 1990 until again it declined from there until the recent years. So just like what we have discussed a while ago, so we will just run through this because it's already explained. So there are different classifications of insurance. So the most common types are the life insurance and property and casualty insurance. So we say life insurance, this is to relieve some of the concern associated with either eventuality. So we have already discussed this. It can be disability, annuity, and health insurance. So it will pay you or your beneficiary if you die, so that it will protect those who depend on your continuous earnings. So when we say annuity class, it is an insurance product that will help if you live longer than what you expect. So for an initial fixed amount or stream of payments, the insurance company agrees to pay you a fixed amount for as long as you live. So if you live a shorter life, so the payout of the insurance companies is expected to be lesser. So if you live long, your insurance company may pay out much more than what is expected. the law of large numbers says that when many people are insured, the probability distribution of the losses will assume a normal probability distribution, a distribution that allows accurate predictions. So this is very, very important because insurance companies have so many people to be serviced. This law tends to make their predictions quite accurate, and it allows them to price the policies so that they can earn a profit. So this is what they research and study in order for them to earn profit. So we already discussed the term life, which is the simplest form of life insurance. It pays out if the insured dies while the policy is in force. So it contains no saving elements, just a payment to the beneficiary when the policyholder died. So if the period expires, there will be no residual benefits. So as the insured ages, the probability of death increases. So what will happen to the cost of the policy? It also rises. So it's better to get a life insurance as young as possible because having it on a later stage, later years, will make you pay a higher premium. That's what is the rule of insurance companies. A whole life insurance policy pays a death benefit if the policyholder dies. It usually requires the insured to pay a level of premium for the duration of the policy. So in the beginning, the insured pays more than if a term policy had been purchased. So this overpayment accumulates as a cash value that can be borrowed by the insured at reasonable rates. So in the late 1970s, whole life policies fell into disfavor because the rates of return earned on the policy premiums were well below rates available on under investments. So it has given rise, fame to universal life insurance. This type of plan combine the benefits of the term policy with those of the whole life policy. So its major benefit is that the cash value accumulates at a much higher rate. So it is structured to have two parts. So one is for the term life and the other one has savings. So it has savings component. An important advantage of this policy is that it has many other alternative investment plans that is interest earning on the savings portion and is tax exempt until you withdraw it. So to keep this favorable tax treatment, what is the treatment of the cash value? The policy cannot exceed the death benefit. Assets and liabilities of life insurance companies. So they derive their funds from two basic sources. First, they receive premiums, so the payments made by their clients. So it represents future obligations that must be met when the insured dies. Of course. Second, they receive premiums paid into pension funds managed by the life insurance company. So these funds are long-term in nature. So this figure shows what is the distribution of the assets of a life insurance company by the year 2008. So as we can see, most of its assets are in the form of bonds and then stocks, mortgages and loans, and then miscellaneous assets. So health insurance. So individual health insurance coverage is very vulnerable to adverse selection problems. So that's why we have mentioned that it's better to get a group health insurance policy rather than individual harm to combat the effect of adverse selections. So people who know that they are likely to become ill are the most likely to seek health insurance coverage. That's pretty obvious. So this is a graph of the percentage of life insurance company assets invested in mortgages, property and casualty insurance. It was the earliest form of insurance. It began in the Middle Ages when merchants sent ships off to foreign ports to trade. So this can be a protection against losses from fire, theft, storm, floods, earthquakes, explosions, and even neglect. So when we say property insurance, it protects businesses and owners from the impact of risk associated with owning a property. For instance, insurance for your office, your equipment. This includes replacement and loss of earnings from income producing property, as well as financial losses to owners of residential property. Casualty insurance or liability insurance protects from harm the insured may cause to others as a result of product failure or accidents. For example, part of your car insurance is property insurance, which pays if your car is damaged, and part is casualty insurance, which pays if you cause an accident. If you are the one who is responsible for having an accident. So that's a casualty insurance. So both property and casualty insurances are different from life insurances because the property and casualty insurance is usually on a short-term basis rather than the life insurance. It is also limited to insure against one event. Property and casualty companies insured against many different events. And finally, the amount of the potential loss is much more difficult to predict than for life insurance. Property insurance can be provided in either named peril policies or open peril policies. When we say named peril policies, it insures against any loss only from perils that are specifically named in the policy, whereas open peril policies insure against all perils except those specifically excluded by the policy. So one way that insurance companies may reduce their risk exposure is having a reinsurance. It allocates a portion of a risk to another company in exchange for a portion of the premium. So meaning the insurance company will bring into another company the risk. That second company will assume the risk, and in exchange, a portion of the premium that the original insurance company receives will be paid as well to the reinsurance company. So it allows the insurance companies to write larger policies because a portion of the policy is actually held by another firm. So it brings them, the second company, insurance company or other company, it brings them premium, but at the same time, it means absorbing or assuming the risk from that premium. So what will happen to the original insurance company? The risk is lessened or is decreased. About 10% of all property and casualty insurance is reinsured. Smaller insurance firms obtain reinsurance more frequently than large firms. You can think of it as an insurance for the insurance company. So the Terrorism Risk Insurance Act of 2002, it's in the United States. So what happened on September 11, 2001? There was a terrorist attack in the United States. So this led to the insurance industry to rethink its exposure to losses that could potentially destroy even the best capitalized insurance company. So what happened to the United States? So they passed the lawmakers passed a law which is called the Terrorism Insurance Act of 2002, which is limited to acts of international terrorism in which losses exceed $5 million. So what does this act says? So should there be an act of terrorism, the government will pay 90% of the losses. So losses in excess of $100 billion are not covered. Insurance regulation. So insurance companies are subject to less federal regulation than many other financial institutions. So in fact, the McCarran-Ferguson Act of 1945 explicitly exempts insurance from federal regulation. So the primary federal regulator is the Internal Revenue Service, which administers special taxation rules. So CDS, or credit default swaps. It is insurance against default on a financial instrument, usually some kind of a scrutinized bond. Insurance management. So insurance companies like banks are in the financial intermediation because they transfer one type of asset into another for the public. So it is a comparison between insurance companies to a financial intermediary. So insurance companies use the premiums being paid to them to invest in assets. So what does these insurance companies do with our premiums? They invest in bonds, stocks, mortgages, and other loans, just like the pie graph I have presented a while ago. So the earnings from these assets are then used to pay out claims on the policies. So only the earnings on these investments are being paid out to those who will claim from their plans or policies. So that's a good idea. So So screening is to reduce adverse selection. Insurance companies try to screen out poor insurance risk from good ones. So effective information collection procedures are therefore important principle of insurance management. So this is separating poor insurance risk from the good ones. So that's why it is called screening. Just like when somebody apply for car insurance, so the first thing that an insurance agent will do is they will ask the client regarding their driving records, what type of car it is insuring, and other personal matters that may be relevant to the application of insurance. So in life insurance, so what are the most possible questions by the agent regarding their health, their last checkups, maybe do they smoke or drink often, drug use, etc. So that is what we call screening. So risk-based premium is charging insurance premiums on the basis of how much risk a policyholder poses for the insurance company. Adverse selection explains why this principle is so important to insurance company profitability. Restrictive provisions in policies are another insurance management tool to reduce the moral hazard. So these provisions discourage policyholders from engaging in risky activities that make an insurance claim more likely. Just like what we have said, setting a fire control, fire extinguisher, so a system to control fire. So there are restrictions in the contracts or limitations. Prevention of fraud, insurance companies also face moral hazard because an insured person has an incentive to lie to the company and seek a claim even if the claim is not valid. So there are attempts from people to have a claim even though they do not have a valid claims, right? For those people who are thinking that insurance is a profit. So just like the peoples who have not complied with the restrictive provisions in the contract, so they will try their best to make a claim. So some may even make a story that this really happened even though this is not. For instance, one will try to create an accident, but in reality, this is just a fake story that has happened. Cancellation of insurance. Being prepared to cancel policies is another insurance management tool. This can discourage moral hazard by what will the insurance company do? They will threaten to cancel a policy when the insured person engages in activities that make a claim more likely. For instance, they will cancel your policy when you engage into car racing. So entering into a car racing will increase the risk of being into an accident. So the insurance company will tell you that they will cancel your policy. So deductibles, we have already discussed this. The fixed amount by which the insured loss is reduced when a claim is paid off. Co-insurance, So co-insurance, when a policyholder shares a percentage of the losses along with the insurance company. For instance, 75% of the total amount to be paid in a health facility is to be covered by the insurance, and 25% will be your personal counterpart. So this can be a co-insurance. Limits. So there is a limitation on what you can get from an insurance. For instance, the limit of your insurance claim is 1 million pesos. So even though you have suffered amount more than 1 million, let's say 1.5 or 2 million, so the maximum amount that you can just get is 1 million. So that's the limit of the amount insurance. You cannot just get whatever you want. Especially, we have already known that the amount that we're going to claim from our insurance depends on how much we paid out of our premium. So effective insurance management class requires several practices. What are those? Information collection and screening of potential policyholders, risk-based premiums, restrictive provisions, prevention of fraud, cancellation of insurance, deductibles, co-insurance, and limits on the amount of insurance. So in that way, insurance companies may be able to earn profit from the premiums that their clients are consistently paying. So all of these practices reduce moral hazard and adverse selection by making it harder for policyholders to benefit from engaging in activities that increase the amount and likelihood of claims. So with smaller benefits available, the poor insurance risks see less benefit from the insurance and are less likely to seek it out. So companies with multiple lines of business to underwrite credit insurance. So we call this monoline insurance companies. They specialize in credit insurance alone. They are the only insurance companies that are allowed to provide insurance that guarantees the timely repayment of bond principal and interest when a debt issuer default. So a monoline insurance company is a special type of this business. They are specializing in repayments of bond principal. So before we end our discussion, if ever you get a life insurance that says you have to pay it, continue it as much as possible, because if you discontinued your payment of premiums, for instance, you have already paid 10 years, 15 years, you cannot get any single amount from this. So it's already forfeited on behalf of the insurance company. So once you sign up for an insurance plan, so try your best to comply with the terms, because it will be just a waste of funds, efforts, and even your hopes and dreams if you will discontinue it. The insurance company will just earn from all what you have already paid. All right, so thank you for listening. I hope it helps you a lot in understanding insurance companies and insurance products and services. God bless.